Okay, folks, welcome back. All right, so this is going to be a rather quick review. The first thing on housekeeping on the list today, I'm going to mention that this weekend, bring up the calendar here, the 10th of August, your payments have to be in before that. So on 9 a.m. New York time in the States, if your payment has not been made by that time, you will be removed from the membership or the access to the videos, because our weekly review will be posted by 2 o'clock that day. So it's important that you don't miss that payment window, because you won't have access to this weekend's lesson. Okay, so today's just going to be a price action review. I'll have an in-depth lesson for you guys this weekend. All right, so just as a reminder, again, all right, so let's go to the dollar index. This is our daily chart, and we are watching this level down here, 97.17, 97.15, thereabouts. And whenever you get that close, you can always expand down into the big figure. We had price expand down into 97.03, so it didn't quite get down to the big figure. I mentioned that we would probably see it draw down into that level, and if it did, as it hit that level, I would look for a day trading opportunity for this week. And really, there's nothing really much to say about the dollar index. We're waiting to see if it has any willingness to want to rally from here. With gold, as I'll talk about later on in the video, it looks as if gold may really pressure dollar. Usually they're inverse. So if the dollar's going higher, gold should fall, or when gold is rallying, the dollar generally goes lower. We are inside this range again, and for it to come down this far, it begs the question whether or not we see continuation on the downside. I don't think that we'll, more or less range back and forth where we're at here. Either we're going to go higher and break this high, or we're just going to erode and go lower and start making a run for the liquidity below here and clear up some of this imbalance when it's busy. So I want to kind of like move over to Euro real quick, because it's the least for me to talk about today. We had our daily. Let's go out to a daily. All right, so here's Euro dollar daily chart, and our next level of interest is the buy side liquidity pool resting above these equal highs. I want to see if price can expand out of this little range we're working within. The dealing range is from yesterday's high, 112.49 and 111.67. So we're going to see if we can move to the upside in that range. If we break down, I'll be watching this area here for a bullish breaker. I didn't get the bullish breaker this week, and this is the area which I want to kind of like focus on and try to trade off of. Just like I mentioned in the weekend review, I wanted to see us trade down to here. Should we get to that, then I would want to engage price, look for SMT divergence and such between euro and cable and dollar index SMT. And I apologize, this is the reason why I'm late today. You can probably hear the thunder. We had a really bad storm here locally, and it sent our power out, so I can't do any uploads or video work with the power out. So thankfully we've had that restored. So again, if you hear that in the background, I apologize. Nothing I can do. Take it up with the man upstairs. So like I mentioned, I would be interested in trading only when the dollar index traded to its daily level here. I want to use that same idea here on the euro. If we trade down to here, then I'd be interested in taking a trade if we get some other overlapping confluences. Time of day, SMT divergence, things that would support a weaker dollar and stronger gold market, that would promote a bullish stance that would be very high probability in my definition for a day trade. Okay, and yes, I'm focusing on day trade still because we are in the heart of the summer, and August typically is a month where I can be wrong. Okay, so I kind of like dial back my leverage, I dial back my frequency in terms of trading, and I just relax and try to enjoy this summer just like anybody else would. So as a natural order of things around here, the way I kind of like communicate to you what I do in my own personal life, how I view certain times of the year, what is my internal dialogue about that? That's kind of like where we're at with August. It's the dog days of summer, so I really don't want to beat it too hard and try to get too aggressive about my trades. So again, should we trade down to this level here on the daily? That would be my level of interest. All right, so let's drop right down into an hourly chart. You can see we have that fair value gap in here that's right inside of the bullish breaker. We have a nice liquidity pool here. We could make a run for it. I'd like to see it do it really hard, sharp, one single or two single candles. There can't be two singles, can it? I'd like to see one or two large candles run right into here, take the sell stops below this low out, close in this fair value gap, and then trade back to the bullish breaker. That would be a wonderful setup in my mind to look for time of day to support that, and then make a run for the relative equal highs and make an attempt to get up into our next level here, 112.85, which is that buy sell liquidity pool relative to the daily chart for euro. And there's really no reason to go down to a 15-minute time frame because everything salient to what I just said really is seen and framed on the basis of the 60-minute chart. Moving on over to cable. So this is what I showed the other day. I got a comment on my most recent YouTube video by a troll saying that everyone in the mentorship is going to be waiting for me to find a trending market. Well, I don't need a trending market. I can trade inside the range. And it kind of like inspired me to just basically trade both directions just to prove it. And you guys saw the results of that in my Twitter feed. I have the recordings. I have certain portions of the trade screen captured. So I'm kind of like formatting that to put it into this weekend's video. So you can kind of see, as the market was trading to my limit orders and taking it out. I know sometimes it looks silly because I beat up a lot of folks online that do just screen captures of the results of their trades, and you don't really see the movement of the market while the orders are in there because it looks like it could be very easily photoshopped. I don't Photoshop anything, but it just takes a lot of time for me to do everything I'm doing. Plus, it's payment season, so I have to help my family run the admin side of this stuff. All right, so just a brief overview of what was seen on this pair and why I did what I did. Remember what I said in the weekend review. I said that Euro Pound, let's quickly pull that up. I said that Euro Pound would try to run up into, clear its relative equal, which we did here, but this is the one I'm aiming for. I want to see these equal highs get tagged. So I think that's still the draw on liquidity. And because of that, Euro Pound being bullish, I felt that they would keep GBP, or British Pound, in consolidation. And thus far, this week, we've seen that. And I'll kind of scrub the price chart over. You can see that. You've obviously already seen it on your own charts. But I wanted to utilize the market profile as I outlined. I said that on the forum, I felt that Euro would be allowed to rally. British Pound would be held in consolidation, which would translate into a higher Euro Pound movement in price. We have a fair value gap here, a bullish order block, price trading down into it during the New York kill zone. And the market profile and framework I was using was a consolidated range expansion. Now, these are the things that, like I said, we would be moving into more depth, more understanding, more labeling certain phenomena that take place in the marketplace. We're starting to have a little bit more algorithmic perception of what price is doing. And these are things you're going to start hearing be repeated. So it kind of like becomes ingrained in your thought process. So when you see price action, your mind's going to say, oh yeah, we're in a range. Why are we in a range? Well, I gave you the reasons why beforehand. The Euro Pound is most likely poised to go higher. The British Pound market will probably be held in consolidation. And again, these are all things I said last weekend and also amplified on the forum. So you want to kind of like go to that forum thread where I'm doing announcements that kind of gives you my up-to-date views on certain ideas or results of something I'm going to share. But the consolidated range expansion is what that is when the market profile is poised to stay in a range-bound environment, not trending. Okay, we don't need a trending market. Now, it's easy when there's a market that's in trend, But most of the time, you're going to see that the market will work within a predetermined dealing range. The idea I felt we would see is the market would come down, close the fair value gap, the bullish order block. Which order block is a high probability order block? One that has a fair value gap. Boom, there you go. The question everybody asks in the free tutorial membership, the outside mentorship, they'll always say, which order block do you use? I never answer that on Twitter. The number one go-to solution for that question, I say it all the time in this mentorship, and you probably already had that question coming into the mentorship if you're new. It's a fair value gap. Okay, fair value gaps make the order blocks high probability. So we have an order block here, price hits it, and that's the reason why I like this down close candle. That's why it's highlighted. What I waited for was the movement down on this candle here. That's a propulsion candle. Propulsion candles are not supposed to break more than half or the mean threshold of the previous order block. We see that happening here. That's right out of your core content. That's right out of your core content. You don't see that in supply and demand. You don't see that in any other discipline of trading or analysis. It's mine. This is where IPTA will do that last little return back into the order block, pick up more orders, and then expand on the upside. That was my entry. That was my fill. Price expands on the upside, makes a hard run for the rejection block here. Okay, so the rejection block, the highest up close candle, and the closing price, that's the specific price. It's not zones. It's not a supply zone. It's a specific price level I'm looking for. Price runs through that, taps the liquidity above that. I sold the long, and I went immediate short. Now the question is how did I know that it wasn't going to go above this high? 100% of the time, I'm never going to know for certain. I trade with probabilities. I gave you the context that GBP would be kept in a range. That was the premise behind it. Now, I already know some of you are thinking, man, there's no way I could do a trade like that. There's no way I could do a trade like that. It just ran this hard against me, and I know that's what it felt like when I first started thinking about it too. It's scary until you practice, and then you practice, and then you practice, and you get better, and you get your confidence more grows. But going short within like a pip and a half of a high, look at the sales on the entries on the fills, and price cranes lower. Consolidated range reversal. That's this framework. Okay. We're in a large range, trading inside that range with the expectation that we will not break out to the upside or downside. We're just going to stay sideways. So what is the market going to do in that condition? It's going to look for liquidity above old highs and below old lows. The market has an expansion on the downside, some measure of SIBI, sell side imbalance, buy side inefficiency. Price comes back up, closes in the imbalance to the midpoint between the up candle and the remaining range that was created for the next candle, which is the open, or maybe even the high slightly a little higher, isn't it? Yeah, only by one pipette. So the fair value gap here gets closed entirely, but look closely. Okay, this is something that I've talked about also many times now since introducing it. The volume imbalance here, small little gap in there. Now you might look at that, well, it's really not a gap because it closed here. You have to think about IPTA and how it reprices. There was a gap, yes, there was a wick here, and then we opened up here and rallied. There's a lack of any downside movement in here. We get it on this candle here, one single pass, but we didn't get a nice candle movement here or a retrade through that. That's what the volume imbalance. Now, I got lectures and more teachings that specifically deal with volume imbalance, and there's a couple different variances in it, but we see it return right back in there again because it's offering a better rebalancing of buy-side delivery. We have one little single wick here, and it comes down and closes, and it opens up on the next candle here. Usually, you get a return. In this case, we get a return all the way back up, and it'll come right back to the bottom of that candle, and there it is. And then you'll see me have said, in hindsight, you'll be hearing me say it, I traded off the bearish order block. Yes, that's a bearish order block, but I'm entering mainly on the basis of a volume imbalance. So these are things that aren't always in the old 2010, 2011 baby pips version of my videos. All those things I talked about in price, you're hearing about and learning about in depth here. But the volume imbalance, Very, very nice. Look for that in price action. There's tons of those examples, tons of them. Price has an immediate response, trades lower, comes down, hits an order block here, bounces just back to a bearish order block, sells off again, runs the relative equal lows, sell side liquidity pool. There's my exit as it's plunging down. I want to get underneath this swing low and inside of the order block, and you can see that my fill was really nice. I didn't get all the way out down here. In hindsight, I wish I would have done that, but I was looking at the equal lows, and remember, I want to use the low-hanging fruit approach. If I'm up here selling short and I'm trying to come all the way down and I'm looking for this as my target, but also understand that we're in a ranging environment for GBP, or that was what my analysis called for. Are we going to come down below here and trade 20, 30 points below that? Probably not. It might be just a shallow little run below it, and this is what you get. Now, if that's the case, I may not get my order off right below these lows. Some brokers may not expand that low, and my limit order may not be filled. So I'm going to be exiting as it's moving in my favor, and I'll let these guys get smart, and maybe they'll get their order out in the marketplace and filled, or maybe it won't. I don't worry about that anymore. That's how I control greed. I know I want to be out early. I know where the market will most likely reach for. I could care less. I don't want to catch every penny of the move. I don't need it. So over 75 pips, both directions, long and short, just to answer the critic I had. Now, I'm not saying that person, because they may be in the mentorship, I don't know, but chances are they're probably someone I ejected and or never been in the mentorship and think they know everything and they're very salty about it. But the long and short of it is, I showed you all without the inside loop of what spurred me on doing both of them. It's just proving, okay, it's just proving that I can do those things that I teach you in the mentorship. Just because I'm not giving you a plethora of these things every single day. Because what's going to happen is if I give you this every single day, all it's going to make you do is feel even further behind. Like you're looking at what I'm doing or what I'm able to do and thinking just because you went through the first year and then you went through the second year and we're going through the price action models, I should know how to trade like ICT. No, you shouldn't. You should not. No one in here is going to be that good. And that's not a beat my chest scenario. I mean, I got 27 years. Okay, I know you get tired of hearing about it. But some of you guys that are very demanding about what you think what your aptitude should be, what your prowess should be, where you should stand now relative to the time you invested, you haven't even put 6 years into it yet. Okay? So I don't want to hear about it because I'm telling you that's how long it took me. So if you're going to argue and say you should be as good as me, put 6 years in and then you'll start knowing where you should be at. You don't like that number? Too bad, because that's the reality. It's going to take you about that long to know what you are going to do and consistently stick to that. Never deviate from it. That means even out of all the things you're going to learn in the course content and the charter members, the price action models, and the trading plans that come in 2020, all that stuff isn't going to deter you from whatever you settle in on come the 6 year mark, because you found your niche. You found your whatever you're going to be doing. That's it. And you're just going to tweak it just a little bit. You're not going to be going back and forth with different models. You're not going to be trying to reinvent your wheel. You're just going to stay in your lane and do whatever that you feel comfortable doing, using whatever concepts that you gravitated towards while you're in the mentorship. So, and it may be a specific time frame. It may be a model, whatever it is. I'm not trying to press you into any specific mold because no one can do that. You can't do that with trading. It's too personal. It's too uniquely associated to your personality. And just, I can do it all, but I know I can't because of experience trying to teach everybody that I've ever taught one-on-one how to do everything I do. And it's just like they get information overload. They just can't deal with it. And it's frustrating for me because I'm obsessively compulsive. I'm looking at them saying, why can't you get this? This was years and years ago. Now I've learned in my old age that becomes 47 tomorrow, I will look back and say to myself, I was really foolish as a young educator because I felt that just because I could show them in a couple examples and the sample sizes that I required to learn weren't many, I expected everyone else to have that same aptitude. And it's not that I'm smart or genius or anything like that. Certain things that I'm keyed up on, I process very quick. Other things I can't process real quick. Like, I can't play the guitar as much as I want to play it. I've tried several times. I can't do it. Put me in front of a price chart, and I'll tell you what's going to happen. But you're going to find your own way, your own time, and don't force it. Just know that you're in here measuring yourself up against me, and I should know this by now. No, you shouldn't. No, you shouldn't. And if you think that, then you're just going to make your learning curve even that longer, much longer actually. So we had a shallow run below the equal lows here, and then price short-term break in market structure. Once you come back into the middle of the range here, so you have a dealing range high, dealing range low. Price comes back up, expands, goes above the 50 level here, which would take us into a premium market. That's what we have here. So we can now look to sell off and look for liquidity below the marketplace. I don't like this area here. This is too much of I don't trust that wick. Let's put it that way. I would like to use this swing low here for any reference for sell side liquidity pool, and we have a small little fair value gap there, and then we have the bullish order block. So we can see price want to reach down into that. Relative equal lows, expands, pumps one more time, bearish order block, doesn't quite get above the equal highs. Now I'm certain if we did a poll on everyone that could go through their brokers, I guarantee you somebody's broker swept above here. And it's probably going to be the one that if you had an order in, it took your order. And then price does its run below the swing low here, and then makes for good measure below the overall swing low and clears that liquidity out. We have a fair value gap in here, and let's see what the high is on this candle here. See if we get a 21.58. Did we get 21.58 on that? Nope, only went to 51. So we didn't really get an opportunity to go into the fair value gap there. Buy side liquidity pool, relative equal highs, that was there. Price shoots down, relative equal lows, clears that out, and then what's it going to do? Seek the liquidity above the swing high. Does that, and now we go into chop, back and forth, really sloppy. So I'm going to zoom out a little bit. I want you to take in what you see for the price structure of what cable has done. Here's Wednesday, today. Here's Tuesday, and here's Monday's trading. Consolidation, just like I called for. Okay, so these are the things that folks that study my free tutorials, okay, or get their hands on just portions of the core content that are pirated and from members that I've kicked out, they don't have the pieces yet. They're never going to have it because it takes time sitting with me like this every single week, explaining to you what's going to happen, why the protocols are in place, what profiles are going to be used, how the market's going to trade. All that comes from understanding that I can't just simply put in a video or a PDF file and you understand it. You have to learn by experience, being with me over and over and over again. And you'll see how I'm blending certain things. And then as you start seeing things happen in the charts, you'll start kind of like filling in the sentences before I say it. Now, that comes with a lot of time, but don't think that it's going to happen overnight, okay? It's because it's not. There is no secret lesson that I'm going to sit down and tell you, okay, this is the thing we're missing that helps me determine all that stuff. Because it's a lot of things that you have to weigh out. And I saw a tweet and responded to one of the members here say that, I have a lot of rules. I do have a lot of rules. But those rules have protocols, procedures that you have to follow. Otherwise, you don't even consider them. You don't even worry about the... For instance, why would you look at a bullish order block if you're trading at a premium? There's no reason to consider the bullish order block yet. You should be looking at premium arrays, okay, bearish order blocks, bearish fair value gaps, SIBIs to fill in, buy side liquidity pools, things of that nature, mitigation blocks. All those things, bearish breakers, voids, all that stuff on the premium end. So there's a context, and I say this all the time for members that, get very critical, or folks that are not in the mentorship or just rude and ignorant and they don't know what they're talking about. There is a lot of context that's missing from the free tutorials. And it was, like I said, and I've said this many times, and I'm going to repeat it again because we have new members here. The free tutorials were a social experiment for me. I wanted to see if anybody could learn how I learned it, and giving pieces in the order through my journals how I got it. And it didn't show anything. No one got it. Now, if we know that there's a lot of content ahead, to come, and there's a lot of algorithmic thought process and principles that's going to be implemented in 2020. Just know that it's going to be exceedingly more complicated. So every time I introduce something, like I just recently introduced the unrealized dealing range. I got a couple emails from people. I don't understand the unrealized dealing range. Of course you wouldn't. I just introduced it. Okay? So just know that I know that you don't know. I know it. And I also know that it requires me a lot of teachings and a lot of examples to get it so you understand it. But you have to allow that to happen. Okay? So just, we're here. We're not like, you didn't pay, you got a little bit of time, and I'm going to let you out, and then you won't get any more learning from me. This is a community. You're here to learn. I'm going to show you everything I know using the real-time examples and what the markets are providing all of it at the same time. There isn't that hindsight looking backwards stuff. You know what I'm going to do before I do it here. The reasons why it's supposed to happen. I'm telling you that beforehand because I want you to look at the price action and anticipate it on your own. That's how you know you've learned it. And you can start seeing it on your own. All right, so that's the business for GBP. We should see a continuation of what we're having here, continuation sideways for the rest of the week. The euro dollar, again, it has to get down here, run the sell side liquidity, fair value gap is a plus, and then I look for relative equal highs to be taken out, and then euro pound, as a result, expand up, run its equal highs. Now, because this is a weekly chart, it doesn't have to happen this week. It could be a continuation into next week, which is fine. But that's the present condition that we have in the marketplace. Real quick, I shared with you guys the dollar CAD. And we had a sell-side liquidity pool here. And I mentioned how this was a setup through Twitter. So if they're going to run the sell-side liquidity pool here and here, what's the next area for price action? We have a fair value gap in here. Price comes down, closes that, rallies through, market structure is broken, trades back down to a bullish order block, consolidation, dips a little bit more, comes right back into the area that has been traded several times. There's a lot of interest in here. For whatever reason, there was a lot of liquidity that wanted to utilize. So IPTA came back there again, run, fair value gap, bullish order block, back to it again. Now you're probably thinking, well, if you use this area here and you went long, wouldn't you get stopped out? Well, if you're going to jam your stop loss up, yeah, but you don't move your stop loss until you get to an area of first profit, and it won't come up to break even anyway. You're just going to raise it up a little bit. So your stop loss would have been below here anyway. Consolidation expands the upside, relative equal highs. We have liquidity pool up here, which is not noted. I'm just reviewing it, if you will. And the market has a beautiful fair value gap right here. And what's this candle? Bullish order block. What makes it a bullish order block and high probability? It's down closed candle in bullish institutional order flow. We have fair value gap. Price comes down, fills it, hits the order block and the fair value gap, and then price expands in the upside. Rallies through, fair value gap again, fills, expands the upside, and one more run on the upside there. Beautiful, beautiful, beautiful. And finally, the gold market, which is another market I mentioned on the forum. I noted that we would see the, let's see here. Here's the weekly chart. I mentioned the CIVI here, sell side imbalance, buy side inefficiency. We would see the market want to run up into that, and we've seen it do that. I think it has a little bit more room to run. If we go over to our chart here for the 15-minute time frame, this level is what I tweeted today. I said, look at this area in here. What do you see in here? This is a 15-minute chart. If you go to a 5-minute chart, you'll see the order block that I highlighted here. And at the time of the recording or screen capture, the candle was a bold down close butt-ended candle. It didn't have the wick yet. This level here is the previous day, or the August 6th high. Right here, August 6th high, and down close candle. Bullish order flow, which is what I told you on Monday. I showed you when the chart was at 1474. Go look at the forum. And this is what we got. We have the order block here at the previous day's high. Market comes down, optimal trade entry. Remember that stuff? You don't see me talk about that that much, do you? Because that's not what it's all about. But I know folks in here are used to that. So you can see it trade down into the order block, sweet spot, expands to the upside. Beautiful, beautiful, beautiful. We have a fair value gap in here. Low hanging fruit order entry is the low. It wants to trade to 1481. That's all that's necessary. We can be long. We do not require the fair value gap or void to be filled in. And the low is 1481. So you add the spread to that. You'd be long here. You can capture around here. Write all this out. Expand up. This was the move to 1500. And the level of the low end of the weekly SIBI was 1495, which is the range on the weekly SIBI is 1495 up to 1540. So we expanded above 115, and you can see in the video that this was already waiting, so when price would go through it, it would be popping up on the chart. And I mentioned on Twitter that the levels that one could utilize would be 115.50. I'm sorry, 115.15 and then 115.40. The big figure, 115, I'm going to teach you all about this movement here and then where we traded to here. Just know that I'm saying it now before we go to the weekend lesson, because I'm going to teach you more about unrealized dealing range, and also when we get into targeting, how we can work within that too, using SIBI and BISIs. So beautiful, beautiful delivery of price on gold. So again, these are all things working in non-Forex markets. So it's not that it's only working in Forex because it's my favorite asset class. It's the way markets are delivered in price now. So know that what you're learning is applicable to all asset classes. You do not have to stay in the asset class of Forex. I know there's a lot of people that came in by way of crypto, and you want to utilize all that stuff there. Apparently it still works there. I don't actively follow it enough that you'd be considered interested in it. But I know I have a lot of students that do take money out of the crypto markets using what I teach. Some of you have mentioned in email that you want to move from Forex into futures. And you will be glad you did, okay, because it still works there as well. I came from that asset class into Forex, and I know the question is why did I leave? I actually had an interview with a gentleman that runs a podcast. I think he will be posting that on the Twitter and Facebook and YouTube next week or the week after. I don't know, but when it's done, you know, I'll share it with you as well. We did the recording last Friday, I think it was. So I spent an hour with him and I answered that question, you know, why I moved from futures to where I am today. So with that, I'm going to wish you all a very, very pleasant day. And tomorrow I'm going to be preoccupied with my birthday. I'm going to be doing a little shopping spree for myself. I do that every year for my birthday. So I go out and kind of like pick out whatever I like, a couple clones, shoes, and a watch, and then some clothing. And that's what I do. That's my normal routine for my birthday. And I probably won't be that active on Twitter. So if I don't seem like I'm responding or communicating with everyone, it's because I'm doing all those things there. All right. So until I talk to you this weekend, again, reminder, get your payments in. Otherwise, you will be removed before this weekend's review and lesson. And until then, I wish good luck and good trading.